Okay, we're live. Good morning, everyone. This is Jim and Anna with our show Live with Jim and Anna. Hi, Jim.
Hi, Anna. How are you doing? Where are you at today?
I am in the same location as always, my office in Burlingame. Can you see my background? How about you?
Yes, I do. It's pretty fancy.
Yeah, I've worked really hard. Anyway, where are you at? It looks like you're in the car.
Yeah, I'm in the car sitting in my son's driveway in Santa Barbara, where we just had breakfast with my son and his family and four out of our five grandchildren.
Yay.
Carol's in the house, and I'm in the portable Jeep Cherokee studio.
Okay. Well, we're still going to be asking you questions, so I'm glad you're all set up.
Thank you.
Yeah. Okay. So you want to go ahead and get started?
Sure, let me ask you a question. Can I do that, Anna?
All right. I'll go first. Sure.
When do you cut your kids loose from your health insurance plan?
Yeah, that's a good question, Jim. So there's a couple ways I want to approach this question. Number one is let's evaluate what makes sense to whether to keep the kid or your children on the plan, on your current plan, or have them get their own insurance. So there's a couple ways to approach it. So the first is to evaluate the cost. Obviously, that's probably why someone is asking this question. Do they have a job? Have they graduated from college and started working? Now, with the new Obamacare rules, a lot of the, plans now allow parents to keep their kids on their health insurance until age 26. So maybe they did graduate from college and have a job, but maybe that job doesn't offer a health plan. So there's an opportunity there for children. Now, I want to look at this from two perspectives. When do you keep them on the plan, and when it makes sense to kick them off? So consider the cost, that something that we discussed. Now let's look at some other options. So like I mentioned earlier, there's some jobs they do offer health benefits. So then if that's the case, then you put that in the category of what's the cost of them having their own plan versus keeping them on your own plan. Now, a lot of times when kids graduate from college, they move away and they may live in a different state. So the question is, does the health plan that you currently have offer national coverage? Not all plans offer national coverage. So if your child lives across the country, like I do, I'm in California and my parents are in Maryland, and not that I would qualify for any of their health plans, but that would be something to consider, because there would be an out-of-network coverage, and that gets more expensive. So, and then the second point or third point is that are they still underage and be able to stay on your plan? Now, when does it make sense to kick them off? A lot of times when you start a new job, their employer offers a good benefits package, and so health insurance is a typical benefit that you get. And when you're single, usually, a lot of times, not all the time, because we look through a lot of benefit packages for our clients, but typically the employers offer to cover the cost of the employee. So a lot of times you can get lucky and just have a very basic insurance coverage, health insurance coverage, covered by your employer. So then that wouldn't make sense for you to stay on your parents' plan. The last piece to point out too is, let's say you do have a job and it doesn't offer it doesn't make sense to get your parents to stay on the parents' plan. So then why not consider something called a catastrophic coverage? And now with the option to go on Obama Exchange or Health Exchange, and you can get the coverage yourself, look for these catastrophic coverage plans. They're usually high deductible kind of plans with low premiums. So, and that kind of coverage will be there in case something really catastrophic happens. So for more preventive kind of things, and I'm assuming you're healthy and don't need the insurance that much. So in case something goes wrong, you do have a plan. Yes, there's high deductible, but at least the premiums stay low. Jim?
Yeah, I had some connectivity problems. Can you hear me?
I do. I can hear you.
Okay, sorry about that.
that's okay. I hope our listeners could hear me. You can hear me part of the question or part of the answer?
I heard you up until right the very end.
Oh, okay. We'll have to see. I'll type up the answer too, so that in case it didn't come clear. Okay.
Okay.
Well, let me get on to your question.
Yes.
Now, last time we had questions about college funding, so I think the streak continues. So this question reads: can I use life insurance to fund college expenses?
Well, Anna, that is a question that comes up a lot when people are dealing with life insurance agents. Can you believe that?
Oh, I'm sure they find lots of good reasons why you need to buy life insurance.
And our listeners might remember that I used to be a life insurance agent.
Yes, Jim?
So I was trained to
Oh boy, Jim, I don't think I can hear you. Oh boy. We've got 5 viewers and we don't have connection. I'm gonna wait just a second and try to call you. Oh God, okay, all right, well, Jim, I think you're coming back on. Maybe I can take over the next question. I can see you, but there's no sound.
Can you hear me now?
Yeah, are you back? Yes, I can hear you.
Well, life insurance is a vehicle or a product that can solve a lot of problems, but it's primarily to provide capital when someone dies and we were counting on them for salary or other blocks of money. That's the primary purpose for life insurance. But because it's got a lot of tax benefits, agents and companies over the years have said, gee, because it compounds tax deferred and sometimes it's tax free, it's a death benefit, it always is. But in other cases, you can borrow out your premiums and whatever the dividends might be and pay a modest fee to the insurance company and not have to claim it on a FAFSA. A FAFSA is a federal application for student assistance in the area of attendance at college. There's a federal form for that, and some private colleges have their own kind of form. But you don't have to disclose, and they don't ask for, the cash value of life insurance. I've come up with a list of pros and cons, and maybe I'll try to share it here and see if I can. I'll also put a link to this. Can you see that, Anna, the pros and cons? It's kind of small.
Yes.
Okay. But life insurance, and we're primarily talking about whole life, which is a bond market play, or universal life, which is also a bond market play, but you take a little bit more interest rate risk to get a higher return, but you could also get a lower return. And so anyway, those are permanent life insurance. One of the good things is there's no control over who you give the money to if you take it out as a return of your premiums and a loan on some of the gain. You can't take everything out because that would collapse the policy, and there's a tax hit if you would do that, collapse the policy. Also, secondly, it's not limited to what we call qualified education expenses. There's a IRS pub on that, and that's what the 529 plans are constricted to and limited to, is only qualified education expenses, whereas your proceeds out of a cash value life insurance policy can be used for any particular issue you want to fund. What happens is there are some limits on how much you can put inside of a life insurance contract in the first 7 years. After 7 years, you can put in a lot more money, but it usually takes 15 to 20 years to grow it big enough to have a what I would call a wad of cash to borrow back out to use for college funding. So there are some limitations there. And that's one of the cons. The second one is if you don't pay back the loans, they continue to grow because you owe interest to the insurance company. And at some point, it'll eat up all the cash, the policy will collapse, and you'll have that tax hit again. So I've made a list of all the pros and cons of using life insurance. It can be used. It's not one of my personal favorites. I would think a Roth IRA, you can borrow out your deposits without any tax consequence, not your gains, but your deposits of principal into Roth IRAs. That's another funding source. But I think both you and I agree that the most tax advantaged way to save for college are the various states' 529 plans.
Yes,
Okay?
Jim, I do agree with you. And as you recall, we used to volunteer for Maryland 529 plan.
Exactly. Well, Anna, would you like to answer another question? And let's see if our...
Yes, I am. I could take a question, but I'm also thinking if I lose your connection again. One comment, your video is not on. And to our viewers, you guys can submit questions on your screen on the left-hand side. There's I think a yellow button or something says join the conversation. So click on that and I should be able to get your questions coming in. Oh, there you go.
Do you see me now on video? Okay.
I think we're back up.
I have to be my own controller here. I need a technician to help me sometimes.
Okay, got it. All
I
right.
have a question for you here. We're ready to go.
Go.
That is reverse mortgages in retirement. Is it a good idea or not? This person writing in says their mortgage is $80,000, their home's worth $470,000. Should I refi to lower my rate? Should I consider reverse mortgage? I'm not sure what the goal is of this person, so you'd have to relay that to our audience too.
I'm not exactly. I guess the question is they're inquiring about whether to pay off the mortgage, the small amount of mortgage they still have left, which is $80,000. I don't know what the rate is, but I'm assuming if they want to refi, it's probably higher than the current interest rates. And they're also wondering because they have the equity in the home, it's worth $470,000, and I presume that they want to stay in this home forever. So I guess the question is, does it make sense to pay off the mortgage, refinance it, or should they consider the reverse mortgages? So that's my understanding of it. So I'm going to try to cover these points.
Okay.
The first thing, I guess, if we want to look at the options of refinancing, now I want to know if this person is retired or not. So if they haven't retired yet or planning to retire, then they probably need to jump on this refinance because you need to show a steady flow of income, right? So if you're still working, probably the best to start the refinance process. As it might be harder, it's still possible, but it might be harder to qualify for a mortgage. It's not a very large balance, but at least that's what I've heard from our various friends who work in the mortgage industry. Okay, so if we do refinance the mortgage, then what does it help you achieve? Okay, you're going to get a lower rate, which will probably lower your payment because what you're doing is you're extending the life of the loan for the next, I'm assuming, 15 to 30 years. So you will always have a mortgage payment going into the retirement. Yes, it's going to be smaller mortgage payment, but you will always have it. So refinancing this kind of amount of loan is an okay option, but let's kind of look further and think about what else is out there. Now, with reverse mortgages allow you, if you have, in this particular example, someone has so much equity in their home, and they want to stay there, then how do you tap into something like that? So reverse mortgage allows you to eliminate, if you still have a mortgage, eliminate those payments. And so it's kind of like this: the bank now starts paying you as opposed as opposed to you paying the bank for the amount of loan that you have outstanding. And so the bank is counting for that equity in the future to be there when they get a hold of your home. There are different options how you can access the equity in the home. So a lot of times we do get this question whether reverse mortgage is something to consider, especially for those who want to stay in their home forever. So there's a couple ways how you can access the equity on your home. And in this example, where we have a small amount of our loan still outstanding, I think that it might be wise to consider taking a lump sum, okay, paying off the mortgage, and then not worrying that you still have that mortgage payment. Now, with the reverse mortgages, when you take, if you take a lump sum, so there's three ways how you can access the equity. If you take the lump sum, you just take the lump sum and you're done. You pay off the mortgage, you have no more mortgage payments. If you ask for something called the line of credit, then that's just it kind of works in reverse, like the home equity line of credit, but in reverse. So you can tap into that pot of money anytime you want, and you never have to pay back the loan. It just accumulates and grows against your equity. And then the third option is to have an equal stream of payments. So let's say you wanted to receive $1,000 a month from for the rest of your life, or for a number of years. So you just ask that reverse mortgage to be set up to pay you $1,000 a month, and it starts accumulating against the equity that's available in your home. So in this kind of example, I think we have to look at a couple of ways, but there is an option where you can pay off that loan that you still have and still have plenty of equity, and maybe either set up a home equity line of credit or create a stream of income if you're looking for that additional cash flow. But one thing two things to point out before I close on this question is, even though you pay off the loan, there's still going to be property taxes and insurance you still have to pay. It never ends. And the older you are, and the minimum age you have to be is 62 to qualify for reverse mortgage. The older you are, the larger amount of either lump sum or equity line of credit these reverse mortgages allow you to take, because again, they're counting on you. They're looking at your life expectancy. So if you're a young 62 retiree versus an 82-year retiree or 72, so there's going to be a difference in how much of those dollars will be available to you, and it also depends on the value of the home. I hope that qualifies. It's a loaded question. So, but I hope I covered all the points.
Anna, the one addition that I would make is, my experience is that if you take a reverse mortgage with a line of credit, that if you don't use it every year, the line of credit goes up.
Exactly. It grows by a certain percentage every year. So you kind of have an increase every year that you don't use it.
And that's a feature that I like if people don't need it, but want to have it sort of wrapped up as their emergency fund. That's a great way to do it, because they can watch that line of credit grow.
Yes, I like that idea too. I mean, one other point about reverse mortgages, there's a significant cost up front to set something up like that, whether it's a lump sum option, whether it's a steady income stream, or a home equity line of credit. But a lot of times that can come really handy. So, okay, well, thanks so much for contributing, Jim. Now, let me ask you this juicy question that everybody wants to hear you give us your thoughts on. What do you think of current market conditions out there?
Well, Anna, that is probably the number one topic of the day that we talk to lots of people on that are either clients or prospects. And my frequent answer is the market goes up and down, because the value of companies go up and down based on all sorts of conditions, real or imagined. But I subscribe to a newsletter called the Independent Advisor for Vanguard Funds, and they recently had in their special hotline that they sent out to their readers, and what I'm reproducing here, and I'll put a link to that again in the can you see it now? I'll put a link to it in the comments. This was a history of one-day drops and what the S&P 500 looked like 1 year later. So volatility makes you uneasy. It makes everybody uneasy. But if you look at historically what happened to the S&P 500, which is a good barometer of the US stock market, in almost all cases, you are much better off a year from now. And you might want to take advantage of the old adage that Warren Buffett takes advantage of: buy low and sell high. So I just want to let people know that that listing is available, and I'll put a link to it on the comments here. I don't think people have to worry about it in the long term. That's why we use the 3-bucket approach. And if people have 2 to 3 to 4 years worth of non-market related securities like CDs or high yield savings accounts, if they have emergency funds and those withdrawal funds in bucket 1 kind of assets, then they really don't have to worry about the stock market in the day-to-day. And what this listing I'm showing you provides is, after a year or so, you're probably even better off than you were before.
I like that, Jim. Yes.
That's the short answer.
Right. We support that idea. Do not, unless you can't sleep at night or something changed in your life, we do support the idea of not jumping and making decisions at the wrong time. So
there is another question that a reader sent in. Could I answer that very quickly?
Yes, 2 minutes, please. Go ahead.
Okay. I've got it. I'm going to share the screen again. They were asking about withdrawal rates, and they were focusing on a study that was published in the Journal of Financial Planning in 2010, showing that different asset allocations, that's the difference between stocks and bonds, had different kind of withdrawal rate successes, going from 100% down to 0, depending upon how much you started with at the beginning. The traditional was 4%, and that asset allocation on the historical research was always 50-50. But this study said, well, what happens if you have different asset allocations? And I can also put a link to this chart. But this study specifically, Anna, as you recall, this is where I went from showing on our spending plan a 4% withdrawal rate to a 3.6% withdrawal rate, because I wanted people to be relying on a higher probability of success, because they would be using different asset allocations and we might be recommending different asset allocations. This could cover an hour-and-a-half webinar, and I won't go into it today, other than saying we recognize this study as being very important and changed at least my personal judgment to not demonstrate 4% withdrawal rates, but 3.6. That also feeds into what the government demands that you take from retirement accounts at age 70 and a half, which is 3.6%. So this study and the government's RMD, required minimum distribution percentage of 3.6, influenced me to go to 3.6% withdrawal rate as a demonstration of a conservative withdrawal percentage to count on, indexed to inflation. Okay,
Right.
how's that for 2 minutes?
That's good. Just 30 seconds to add something. And the 3.6%, just to clarify, will give you 100% success rate, meaning there's going to be no chance.
Predicted.
Right.
Predicted.
Right. No chance of you ever running out of money. So once we put the link, you guys take a look at this chart. But I think looking at what our most typical asset allocation for retirees, right? Start out with 60-40. You could go to 4%, you can go maybe into 5%, but you have to be okay with the chance of maybe in some cases, not having enough money at the end. So that's my 30 seconds addition. All right, we are over time, Jim.
Oh no, Anna, I'm shocked.
No questions came in though. we had a few viewers. So if you guys have questions, we're as usual open for them. So email, please. And I wish everybody a very good weekend. And we'll be back next month. Jim,
Bye, everybody.
safe travels. Bye.
Bye.